Welcome back. In this video, we'll explore two more options contract types on the volatility indices, accumulators and turbos. Volatility indices target an annualized volatility. Their value is partially determined by a generated random number. This means that prices can jump up and down unpredictably. However, over time, these fluctuations often balance out. This mean reverting nature makes volatility indices interesting for options trade types like accumulators, which benefit from price ranges, and turbos, which capitalize on directional trends. Let's break down these trade types. An accumulator contract allows your stake to grow exponentially even from small price changes. The payout compounds as long as the price stays within a set range relative to the previous tick. The range size will depend on the growth rate chosen for the trade. To secure your payout, you'll need to close the contract before the price hits the upper or lower barrier. Here's how it works. Accumulators offer growth rates between 1% and 5% on volatility indices. This rate determines how quickly your payout increases as long as the price remains within the defined range. Each time the price stays within the barrier, the payout grows. Even minor price movements can lead to larger returns over time. This is known as compounding. If the price touches or exceeds either barrier, the contract knocks out, and your maximum loss is limited to the initial stake paid to enter the contract. The accumulator charts feature a stats bar that helps you track the history of consecutive tick counts. Simply put, it shows how many ticks in a row the price stayed within the set range. Here's how it works. The count increases with each tick that remains within the range. If a tick breaks the range, the count resets to 0. This tool is great for understanding how often the price stays within the range, which can help you refine your trading strategy. For example, based on data from the stats bar, let's say you decide to set up an accumulators trade on the volatility 10, 1 second as follows. Strategy: growth rate 1%. Initial stake $10. Take profit $1. Approximately 10 ticks. As soon as the trade is placed, the contract value increases with each tick, as long as the spot price stays within the defined range. If you choose not to use a take profit level, you can monitor the trade closely and manually close the position when you're satisfied with the returns. It's crucial to have a solid understanding of market movements and the associated risks before engaging in accumulator trades. Moving on to turbos. Turbos are another type of options contract for trading volatility indices, but they're specifically designed to capture directional price movements. With a turbo contract, you can predict whether the price of the underlying index will rise or fall during the contract period. If you believe the price will rise, select the up option. If you expect the price will fall, select the down option. The payout for turbo contracts is determined by the payout per point, which depends on how far the final price is from your chosen barrier. The closer the barrier is to the spot price when you enter, the higher the payout per point. However, this also means more risk. Turbo contracts can be traded in two ways. Tick contracts. These are short-term trades that expire within 5 to 10 ticks. You'll need to wait for the position to expire. Minute contracts. These can last anywhere from 15 seconds to several days, and you can manually close the position before expiry if you choose. Let's walk through an example of trading a turbo contract on the volatility 10 1 second index. Suppose you anticipate the price will rise over the next 10 minutes and decide to go with an up contract. Here's how you set it up. Payout per point, 1.8 USD. Duration, 10 minutes. Initial stake, $10. Take profit, $10. Once the trade is placed, it is important to monitor the price action. If it moves in your favor, you can either let the trade run or close it early if you're happy with the profit. Both accumulators and turbos come with their own risks. especially in volatile markets like volatility indices. Here are some key tips to manage those risks. Start small. When testing new strategies or market conditions, begin with a small stake to minimize risk while gaining experience. Use take-profit levels. Always set a clear level to lock in your gains when the price moves in your favor. Monitor closely. Volatility can be unpredictable, so monitor your positions and adjust them as needed. Successful options trading is about learning, practicing, and managing your risks. Start with a demo account to refine your skills, and once you feel confident, move on to live trading. Take the time to explore both accumulators and turbos to find the trading style that works best for you. This wraps up our advanced course on derivatives. You now have a solid understanding of various options trade types and how to apply them to different derived indices. Start with a demo account to build confidence. And remember, practice makes progress. Best of luck on your trading journey.